Quick disclaimer, everyone. This is purely for educational purposes and is not financial advice. Investing always involves risk of loss. Okay, let's get right into it. Hit the like button, subscribe to the channel, and drop your thoughts in the comments below. Retail investors are buying up decentralized network tokens, waiting for massive returns, completely missing the mathematical reality that they are holding the digital equivalent of penny stocks. Today, we expose the liquidity drain and why the smartest capital on Earth is abandoning the digital casino to hoard the Apex asset. So here's our roadmap. We're going to start by dismantling the idea of the digital casino. Then we'll dive into the real dominance metric, the one that actually matters. From there, it's the smart money playbook, the macro consolidation, and finally, we're going to tear apart the illusion of diversification. All right, let's start with the ground truth of where we are right now. For a long time, the consensus was that this was a non-zero-sum game, right? A rising tide lifts all boats. Well, that party is over. What we're seeing now is a profound structural deleveraging. It's completely split the market into two distinct categories, signal and noise. The problem is, the metrics that most people are watching are practically designed to hide this fact. They make it all look like this big, bustling casino, when in reality, the house is just siphoning off everyone's capital. And this is where it gets really interesting, because the truth is hidden in plain sight. It all comes down to the single most watched and most misunderstood metric in the entire space, dominance. You see this thing everywhere. The standard dominance metric. It's a simple idea. Take the market cap of the Apex asset and divide it by the market cap of everything else. It's supposed to tell you where the money is flowing, towards safety or out into risky bets. But, and you have to understand this, that standard calculation isn't just flawed, it's intentionally deceptive. It gets distorted by two huge factors that completely warp the reality of the situation. Okay, first, you've got over $250 billion in stablecoins baked into the total market cap. These aren't investments, they're just casino chips, money sitting on the sidelines. Including them artificially waters down the Apex asset's true slice of the pie. Second, the denominator is just bloated with thousands of these illiquid venture-backed tokens. They're penny stocks, plain and simple, and they inflate the size of the so-called market. Therefore, the pros, the institutional traders, they throw that number out. They calculate what's called real dominance. And it's simple. You just subtract the stablecoin market cap from the total. This one little tweak completely flips the script and shows you where the actual risk on capital is really going. And this table just lays it all out perfectly. Retail is glued to total, which is all the noise. But institutions, they're laser-focused on metrics like total S, which strips out the casino chips. When you actually calculate dominance using total S, you get the source of truth. And you see that while the casino seems packed, one single player has been quietly raking in all the winnings. So that brings us to the playbook. How does smart money actually exploit this knowledge gap? Well, it all comes down to a massive informational asymmetry. They're playing a completely different game in a completely different arena. See, retail plays in the lit exchanges. This is the public casino. Everything's out in the open, which makes you a target for high-frequency bots and frontrunners. Institutions, on the other hand, they operate in dark pools. These are private exchanges where massive funds can move huge amounts of capital without tipping off the market, absorbing volatility instead of creating it. But the real asymmetry, the one that changes everything, isn't the venue. It's the unit of account. Retail is still counting their wealth in depreciating fiat dollars, getting excited about a 15% gain. Institutions, they've already shifted their denominator. They measure their wealth against the Apex asset and physical gold. In their world, if your little token is up 50% against the dollar, but the Apex asset is up 100%, you just lost half your money. And this denominator shift leads to a predictable, almost predatory four-step cycle. 1, they accumulate a high beta token early. 2, retail hype kicks in and pumps the price in dollar terms. 3, institutions use those dark pools to secretly dump their bags into all that retail excitement. And 4, they take the proceeds and immediately consolidate them into the Apex reserve and gold. You see? The tokens were never the goal. They were just the vehicle to acquire more of the real prize. So what's the big picture effect of this hidden rotation? Well, it's creating a massive liquidity vacuum that's literally starving the rest of the market. You have to remember, the era of free money that pumped this casino is gone. 3 things killed it. First, high interest rates. Why hold a bleeding token when you can get a 4 or 5% risk-free return in treasuries? Second, energy inflation. This actually gives the proof-of-work Apex asset a real-world cost anchor, a thermodynamic floor. And third, the dilution trap. These venture-backed projects have huge token unlocks scheduled, which is just a fancy way of saying insiders are dumping a constant stream of new supply on your head. I mean, the structural differences are just night and day. On one side, you have centralized issuance, massive dilution, and a structure designed for insiders to exit. On the other, you have a fixed supply, no central issuer, and a value proposition based on absolute scarcity. One is a penny stock, the other is digital gold. It's that simple. And the end result of all this is that liquidity vacuum. As smart money rotates into the Apex reserve, these weaker, zombie projects get completely starved of capital. They enter a death spiral. Liquidity dries up, dilution crushes them, and they begin a reflexive slide to zero. It's a financial extinction event, and it's happening right now. And that brings us to the final and maybe the most insidious part of this whole trap. It plays on one of the oldest rules in the book, a rule that, in this case, is dead wrong. We're talking about the illusion of diversification. Retail is told, buy a basket of assets, spread your risk. But that's a total fallacy here. If 19 of the 20 assets in your portfolio are designed to bleed value against the 20th, you aren't diversified. You've just made a concentrated bet on a failing ecosystem, and you're just burning your capital in 19 different ways. Look, the math is clear. The liquidity is moving. This rotation is happening in the dark. The casino is closing its doors on those who are too distracted by the flashing lights to notice. So I'll leave you with this final question. In a financial system where thousands of projects claim to be the future, what is the actual price of the one asset that continuously consumes them all? Hit the like button, subscribe to the channel, and drop a comment below with your thoughts on the Apex consolidation.